So, and Chika asked me not to bore you to death with numbers, so to jump to the best part, which is the recession and how to underwrite in a recession. I'll just address those points quickly. And I was actually talking with this gentleman here before. Putting it bluntly, if you were a pessimist and all you thought of was an upcoming recession, and you factored that into your financial analysis, you simply would not buy anything. No deals would look attractive to you enough, and they wouldn't meet your minimum return hurdles, and you'd get outbid by everyone else who currently thinks the sky's the limit. So that's the harsh reality, and there is no perfect way to find deals that you can outbid everyone in this hot market and still have a very conservative, strong deal that's going to thrive through a recession. So what are we left with? It's how do we find the best risk-adjusted returns and take enough risk where we can earn a return yet survive through a downturn. So I'll talk a little bit more about that as we go through the numbers, but today we're actually looking at a case study called Woodstone Manor. This is a live deal that we just got across our desk earlier this week. It was on market in a 4-pack portfolio, as you can see, in Houston, and all of them are spoken for except this one, so we got the call back and said, hey, we want you to take a good look at this one. The pricing's revised, so tell us if this makes sense. So just to give you an understanding, this is a very typical, so this is your prototypical value-add deal. Houston, MSA, very strong market. All of Texas is on fire, so a lot of people are projecting a lot of rent growth, and prices, obviously, because of that, are elevated. Specifically, there's a very high demand for 1980s built assets that maybe are 20 years, the interiors are 20 years old, so the current ownership hasn't really touched them up, and there's an opportunity to give back to the residents with upgraded appliances, amenities, new flooring, cabinets, and things like that, and that'll typically command a rent premium of $75 to $150. So that's really the name of the game. Can we buy a property that has in-place cash flow, right? We live off cash flow, especially through a recession, right? Without cash flow in a recession, that's where things get tenuous. So we're looking for a deal that has in-place cash flow and has that value-add component that can take the return from a good cash flow asset to a great total return. And if a recession does hit, you can live off the cash flow through that period, wait till valuations come back, and that's when you'll be able to sell and realize the capital appreciation that you're able to bake in through the value add. So another important point to make here is this property is 94% occupied. So what that means is a couple things. Because it's a stabilized asset, typically that means 85 to 95% occupied or more. That means it qualifies for permanent financing, and specifically the most attractive debt in the multifamily, large apartment community market is agency financing. So that's Fannie Mae or Freddie Mac. And they typically lend money on a 10-year term, right? Which even if you're the biggest pessimist out there, it's unlikely that the next recession is going to hit us and last for 10 years. So the idea is have enough term on your debt that allows you to make it through the recession and take refinance risk out of the equation. So what that means is if you take on short-term debt, which actually, as we were talking earlier, short-term debt scares a lot of people. And the reason why is because if your maturity comes up and you need to roll over your loan or sell the property, you might be forced to sell at a period of time where the market isn't on fire anymore. And you thought you could sell the building for $10 million, but market's not so great, and now you're selling at 8. Well, you may just have to based on your debt. But if you have an optimal capital structure, meaning longer term, there's no reason to sell at 8. You'll just keep on cash flowing your asset and wait until valuations come back to 10. So that's the flexibility that we love to see in a, I don't want to say recession-proof, but recession-resistant investment. So that's an important note. This is a 90% plus occupied property. And then on the flip side, the caveat, the contrarian in me just wants to point out that when the equation is so perfect like this, it's a good deal, it's got the upside, it's got the you know, the ugly white appliances. You can put the new flooring in, the new black appliances. You know, I'll probably show you a picture here. There's your classic kitchen, and then there's your renovated kitchen. And then, you know, for this specific property, we would take it up a step even higher, and that would be something like the photo on the bottom. So the caveat is, when the story is so nice like this, there's a lot of bidders here, and the competition is hot, so the pricing is going to be even higher. So on the flip side, while permanent debt is great and a story like this is great, it's very tough to find deals that price out well, and so we actually love deals that have a lot of hair on them. Low occupancy, deferred maintenance, low rents, crime, all the issues that most people are running away from. Those scenarios often give us the ability to get the asset for a price that is much more favorable and actually ends up being potentially, it's higher risk obviously, but a better risk-adjusted return. So you're being better compensated for your risk than on a deal like this, for example. But we're going to focus on this more recession-proof investment. So we don't need to really go into the specifics of the construction and the unit mix specifically, but I'm just going to run through it, give you an understanding of what the property looks like if you're not familiar with these suburban garden-style assets in typically the south and southeast. So here we have laundry facility on site, opportunity to put in washers and dryers. You know, especially in New York City, people would pay a lot of money for a washer and dryer added to their unit, and it's no different in a place like this. It really makes a lot of sense if you have to, let's say, spend $1,000 to add a washer dryer and you can command a $35 rent increase. You know, it's a very great ROI, as you mentioned earlier. Okay, so now we're going to dive to the next portion, which is really diving into the numbers. So before you can do that, you need to have two things. You need to have a rent roll, which is basically a schedule of all units in the property and the status of the occupancy, who's living there, when did they move in, what rent are they paying, are they getting any discounts. So it really tells you a lot about only a snapshot in time. A rent roll is not a historical analysis. It is just a snapshot in time. So this rent roll, if I scroll up to the top, is from August 7th. And then you also need a trailing 12. And now this is a historical document. This actually takes the historical financials going back the trailing 12 months. That's why it's called a T12. Now this gives us a different picture because it says, okay, well maybe the rent roll says the place is 100% occupied. But 6 months ago, it could have been vacant. And now the seller just jammed it with the worst tenants anywhere he could find, grab them off the street, and tries to sell you the deal as a stabilized deal. But the day you take over, all these tenants are running out of your building and not paying your rent. So this gives you a slightly better picture of the historical performance. And here we see the vacancy loss going back to July of let's go this way. Yeah, July of 2017 actually. You can see the vacancy is pretty consistent. 5,000, 3,000, 4,000. So that is not so much of an issue here. So those are the two things you need. You need the T12 and the rent roll. And then next you need some way to analyze these numbers. And so today we'll be using my spreadsheet to essentially plug in the numbers and see what it tells us. So, and without going through the tedious effort to plug in every single thing, fast forward, bang, here it is. So I took what was once a blank page and now this is inputted with all the information. So I'll just run through how I got from the blank to now, and then hopefully I don't lose you and don't bore you to death. So if you look at the T12 and you look at the left-hand side, you've got all these different items. So this would be gross potential rent. So that's your very top. This is what rent are you charging for every unit type, and if everything was leased up at that number, what would be your rent? And that would be $118,000 a month. Now obviously, not all of your units are going to be rented at market rate, right? It just doesn't exist. Maybe you have a friend that you're giving a little discount to, whatever it is. So that is represented by a loss to lease. And then we go down to more loss items, vacancy, non-revenue units. That could be a unit that it's a model unit to show prospective residents concessions, bad debt, people don't pay you, right? You have to write that off. And then there are other income, like you're billing back for utilities. So anyway, so this is I don't want to go through a whole financial statement, but I do want to just show that every piece of that puzzle is then translated here, plugged in. So under annual income, we have those same line items, loss to lease, vacancy, concessions, we have all that factored in. And on the operating expense side, we have the same thing. So if you look on the T12 and just look at something like utilities, right? And here we have 102,000 over there for utilities. And that is just taken right away and put right here. So there's no magic here, I'm just copy and pasting. And now, once you've got all of that here, there's only a little bit left to do. So the other part is how do you have to convert the rent roll to a unit mix that is then analyzable. So really quickly, looking at the rent roll, a little cheat sheet. If you scroll all the way down, there's typically a summary. If there's not, there's software to help you with this. But you can see here we have a beautiful cheat sheet that really just gives us the full picture of the property rather than having to look at every single unit in the rent roll. We just have a summary here. So, and even better, this is also just a great straightforward business plan because what we have is a couple different unit types and partially renovated units. And for this, under this rent roll, you have the R, which signifies that this unit is renovated. So what it shows me is you can see the A1 average lease is about $660. Now with the renovation, and you saw those pictures a little before and after, they didn't go all the way, they just did a couple things, but those units are nicer. They're now getting $693. So that's a nice jump. Question is, can we take it a step further? We don't know yet, but it shows you that there's in-place proof of concept, and that is a very powerful thing when we're looking at these deals. If you can see that there are already units in place that are renovated and hitting that rent premium, it's a no-brainer. You can call it in-place comps. You don't even have to do comps necessarily outside of the property itself. Obviously you do, but it's definitely a help. So one thing I did here is I basically just took these partials, or these renovateds, because our business plan would be to take it the next step, but for now we're just assuming that, hey, whatever the top rent is, we can pretty much factor that in. And so what I did is I went one by one through the rents and found the highest rent being achieved by the renovated unit, and I plugged that in as the pro forma, which is my projection for the future rents. So as you can see, unrenovated and renovated on the A1s, 660 or 700, and the highest rent currently in place is 730. So all we're assuming is, hey, if we can do as good as the current owner, we'll renovate and bump the rents to what's already being achieved at the property. And that's pretty much seen throughout the unit mix. So now we've covered the income, expenses, right? All I said was just copy and paste, and then the unit mix. Now the fun part, assumptions. So this is where most of your time is spent, right? Because the numbers are the numbers. You can't really play with them all that much, but your assumptions are what make or break whether your deal actually makes any sense. And skipping over, I'll just briefly touch on some of these. Closing costs 3%. These deals take a lot of ancillary costs to close. It's just something to factor in. Operating reserve, and since the title of this topic today is dealing with a recession, there's nothing like cash to get you through a recession. So right here, our off the bat assumption is to reserve up, and you can see the formula up there. What that is 2 months of operating expenses. We want to reserve up in the bank account day one. There's not necessarily any magic to why it's 2 months. It just feels right. Having $125,000 in the bank is just a nice thing to have, especially when you're cash flowing day one. So theoretically, you don't need it, but it's there. I don't want to go too far on debt, but obviously you got to factor that in. And like he said earlier, leverage is a great way to make a lot of money. So prudent leverage, like we discussed earlier, short-term loan, long-term loan, that all has to be factored in. To the risk-adjusted attractiveness of the deal. And then stabilization assumptions. So this, requires experience, talking with your property manager, viability in the market. But for this deal, we're saying, well, hey, let me just make sure I'm right. So this is, 144 unit deal. So we've got 52 units that are unrenovated, untouched, and 92 partial. So on a blended average basis, we're going to spend $2,300 renovating these units. So the ones that are untouched, maybe we're going to spend $4,500, and the ones that just need maybe upgraded countertops, maybe it's only $1,000. So blended average there on 144 units, and we're going to say to get through all these units, assuming average market turnover rates, it'll take 15 months. So this is the first assumption that has a very big impact on your deal. Because what if we just assume, hey, it's going to take 3 months, and we're just bang. Like I've seen people say, oh, well, the property's got 15% vacancy right now, but year one it'll be 5%. We'll just take over and it'll be fine. And you say, well, it doesn't take time to get A to B. So this is a big one that a lot of people overlook because, number one, it's hard to kind of incorporate into your analysis. But it's one that's got to be in there, and it is sensitive. And we'll go into sensitivities analyses and show you just how sensitive the return projections are to an input like that. So hopefully I move fast enough we can get to the good part. Exterior budget, there's always deferred maintenance, there's always things that we want to spend money on the exterior. Going in vacancy rate, 5%. Maybe I'm a victim or a perpetrator of what I just said, don't do, but if the property is currently 6% vacant, maybe we should project 6% going in, or 5.5. Maybe I'm not being as conservative as I should be, right? So we'll adjust that. And I should have mentioned this earlier. Feel free to stop me if something doesn't make sense. You want to ask questions? Let's make it interactive. I could get lost. I'm a nerd. I'll dive into this really deep. So I don't want to lose you. Let's stay on task and talk about what you guys want to talk about. So the next input or assumption that can make or break your deal is the annual rent increase. So this is a very sensitive input, and it'll change the returns drastically. And I'll just show it to you right now. So right now, with everything we've been looking at so far, this deal is projected to return on a net of fees basis. So to the investor, after all the fees and all the shared profits are taken, a 15.9% IRR, or a 17.7% annualized return, whatever.
You mind explaining what IRR is in case most people aren't aware?
Sure. IRR is kind of the benchmark number that people use to assess the return of an investment that has a variable cash flow in and out profile. So if you're investing in a bond and it just returns 5% and it just spits out that return every month, every quarter, that's a simple annualized return. It's nothing more complicated. But on a deal like this, you're going to have cash flows coming in here a little lighter, a little heavier, and then you've got a big windfall when you sell it and make your money. So it's not as accurate to analyze that through an annualized return because doesn't take into account the time value of money. So what IRR does is it's a compounded rate of return, basically saying money coming to me sooner is valued to me more than money coming to me later. Because if I said, hey, this deal makes an annualized return of 15, but you're not going to see your return 30 years from now. I mean, I want my money now. I want to enjoy money now. So it's definitely the preferred metric for pretty much all private equity investing. And if someone wants to talk to me one-on-one about the math behind it, I'd love to. So, but we've got a 15.9% IRR. You can memorize these figures here. We got 11% cash on cash. That means over the 5-year life of the project, we're projected to cash flow at 11% on average. So let's go and say 2% annual rent increase rather than 3%. The numbers just dropped a good amount. If you were looking at the annualized return, it was a 17.7, and now we're down to 14.7. That, for investors, is a big deal, right? Some investors think of a 17 and say, that's great. and then all of a sudden now you're pitching a 14 and it's a whole different deal. So it's a very sensitive input, but unfortunately the reality of the hot market is you pretty much have to be aggressive and project that we will continue to see historically strong rent growth in order to win these deals. Because if you are a pessimist, like I said before, and only saying, hey, rents are only going to grow at 2%, or hey, I think a recession is going to happen and they'll grow at 0%. If I say 0 here, that's very pessimistic. And if you're projecting an 8.9% return, you're going to say, well, I need not a $10 million purchase price, I need to buy it for 8 for it to make sense for me. But you've got 10 other buyers who would say, you know what, 10, 15, 10 and a half, 11 works for me. So it's a delicate game that we have to play. We want to under-promise, over-deliver, but we still need to be able to be optimistic in order for these deals to make sense at all. So, and if the market's been very strong, 3% rent growth, not a problem. So, but just be careful and be aware of what people are using for their projections. Because if I go on the flip side, and no names, but I have seen it before, 4% rent growth, all of a sudden it's a 20.8% IRR, and you're projected to over double your money in 5 years. And if you see metrics like this on a deal that is conservative like this, because you can't have it all. You can't double your money and take no risk. But if you see something like this, definitely be aware, because that deal is either not underwritten conservatively, or it is underwritten conservatively, but they're taking more risk than you may be comfortable with. So just be aware. So we'll just back this back down to 3 and try to plug along. So these are just, property tax increase 4%. Texas specific things, so I don't want to go into it too far, but property taxes in Texas are nuts, and they reassess you like crazy, and especially when they see you value adding a deal and bumping the rents, they say, oh, that landlord's got more money because he's increasing rents, so I'm going to increase the taxes on him. So a lot of people miss that, and they under project their taxes. So it's good to have a 4 to 5% tax increase, as well as a big bump. So they're currently paying $150,000 in taxes, and we're projecting day one, as soon as we buy the property, it's going to jump to $192,000. So that's probably not going to happen, but it's going to get there eventually. Maybe it takes 2 years, maybe 3, but that is not uncommon in Texas. So another, it's a Texas-specific thing, but just beware. And then finally, we get to the terminal cap rate. Now, this is where it gets more jargony and specific, but all this really means is it's a calculation that determines your sale price. And as you know, if you project, you don't have to be a math whiz to know that if you're projecting a sale price of 12 million versus 13 million, those returns are going to be very different from each other. So this is a highly sensitive input due to that. So 7% cap rate, if you're not familiar with cap rates, this may not hit home quite as hard, but I would say projecting a 7% exit cap rate in today's market, in a strong market like Houston, is a conservative estimate. Deals are typically trading right now in the 5s, and you have to see some serious cap rate expansion to be selling at a valuation like this. But it is a good thing to be modeling into your analysis. So what this cap rate tells us is, based on where we think our income will be in year 5, we're going to sell the property for $12.8 million. Now, if I change this to 6 and say, you know what, the market's going to stay the same. People are buying deals for a 6 cap all day, and so there's no reason why I shouldn't be able to sell it at a 6 5 years from now. All of a sudden, I'm selling for $15 million. I don't remember what I just said, but that's a big jump. Yeah, 12.8 or something. So, that's a material jump. So that's another one of those sensitive inputs that you definitely want to be aware of. And similarly, if you were very pessimistic and you said, oh my gosh, the 10-year U.S. Treasury is going to go to 4, and people are going to be demanding an 8% yield on real estate, you're no longer selling that deal for 12.8, it's 11.2. Now, if you look, the IRR is still 11.1, and our cash flows are still 11%. So although we changed the sale price, our operating performance didn't change. And what this tells you is this is actually a very strong deal, more than we're giving it credit for, because if cap rates did expand to 8%, why in the world would we sell? We have a great asset that's cash flowing at 11%. Who's making 11% in their bank account right now? Right? So that is an asset that you'd much rather hang on to than sell for not an optimized sale price. So for me, if it's year 5 and that's when we thought we were going to sell based on our business plan, I'd say, guys, we've got plenty of term left on our debt. Let's keep cash flowing this deal and wait until valuations go back to 7, and then we'll sell at 12.8 and make our big return, mid to high teens. So that's another interesting point. Focus, if you are aware of the recession coming and you want to base your investing on that notion, focus on deals that have great cash flow. Maybe not necessarily in place, but that's obviously a plus. But be wary of the deals that bank on that sale. If the deal does, if the only reason why the deal looks great is because it's projected to sell for double than what it was paid for, that's a lot more risky than banking on the cash flow deal. So like we said, especially in a recession, you live and die by your cash flow. If the majority of your return of an investment comes from cash flow, that inherently is just a much safer deal. All right, so I think I've pretty much ran through all these major assumptions and shown you that you just plug in these numbers and it spits out these results in the summary. I want to jump to the sensitivities. So this is kind of a mess here, but if I'm going to zoom in, so like we were just talking about cash flow. Cash flow is king. And this conveniently tells us the return from cash flow in this deal is 62%. That is very unique for a value add deal, especially at this point in the cycle, because typically deals are bought in for a much lower going in return, and you're banking on appreciation, rent growth, increasing rents through your business plan to get that increase in value and hit your return. So I would say most deals are going to look like 30-40% from cash flow. So a deal that has 62% is a great one. So if you are going to keep some metrics in mind, this is a great one to think about. Here I have the major assumptions laid out. This is also a nice thing just to have handy and just say, just reality check. Do these assumptions make any sense, right? And if you protest them, don't be shy, plug them in. 2% rent growth instead of 3. Can you live with the deal? If you thought you were going to get a 15, but hey, the market is no longer sizzling hot and it's 2, can you live with getting a 13% return? Does that fit with your investment criteria and your goals? And then we're going to look at some of the other metrics. So the way that you make money and lose money in real estate is through leverage, right? So if you can, over there, take on some great debt and double your money rather than paying all cash and make 25%, it makes a lot of sense. But it also has to make a lot of sense from the metric standpoint. And those metrics are loan to value, loan to cost, debt service coverage ratio, and there's other ones like debt yield and things like that. But really, you want to focus on, I think personally, most importantly, is your debt service coverage ratio. And all that means is if you take your income, and let's call your income $125,000, and you divide it by your debt service on an amortized basis. So I love interest only, but for the purposes of this conservative metric, you've got to amortize that debt. As you can see, your month 1 interest coverage, so if you're not paying any amortization, it's 1.94. So you're almost making twice the amount of income as your debt service. But all of a sudden, once that interest only runs out and you have to amortize, it's now back down to 1.39. So that's still a safe margin, but that is a huge difference, if you look at those numbers. So you'll hear a lot of people say, oh, it's going to be bad for all these people buying deals with interest-only debt. When that interest only runs out, their cash flows are screwed. It's true, their cash flows will go down, right? If you were paying $200,000 on your debt, and now you're amortizing it's $300,000, your cash flows are lower. But lenders are much more conservative in today's market than they were in 2000, leading up to the financial crisis. So you're seeing lenders still constraining how much leverage they're willing to give you based on these metrics. So going back what I said at the beginning, the best lenders in this permanent financing space are Fannie Mae, Freddie Mac. They're much smarter than all of us, and well, They make mistakes, but typically if a lender underwrites a deal rigorously, I mean a lot more rigorous than what we just did, and they're extending you a loan, it's typically going to be constrained by the appropriate metrics such as debt service coverage ratio. So now we're going to jump into the sensitivities, which I was talking about. The first one we said was stabilization period. Is it going to take you 3 months or 2 years to get all your business plan done and increase rents? The other one is rent growth. Are rents going to continue growing to the sky and they're going to be 5% a year? Or are we going to see some negative rent growth? There's also vacancy we didn't talk about, but that's also a sensitive input. And then also terminal cap rate. What are you selling for? So I just want to show a couple of these charts. So here we have on this axis exit cap rate, basically what price are you selling for? And remember we had 7 and then we dropped it to 6 and all of a sudden we're selling for 15 million. And it happens. Right now we're more closer to the top of the cycle, but a lot of people made a lot of money over the last 10 years buying at an 8 cap and they sold at a 7, or they bought at a 7 and they sold at a 6. And that is essentially another way of saying appreciation, just in the commercial space. And then we have rent growth. So obviously things can happen outside of these parameters, of these bands, but if you look at our base case assumptions of 3% rent growth, 7% exit cap, that's a 15.9 IRR. Now, let's say, okay, we didn't get the rent growth we were hoping for, 2% now, and you know what, the market, investors aren't as aggressive and cap rates expanded to 7 3/4. Now your IRR is only 10. So we're not losing money, it's a 10% IRR, right? 10% average annualized return essentially. That's still pretty good. I mean, and just to be honest with you, based on where we are in the market today, I do think prices are higher historically than lower, and I think things are better historically than normal. So I don't want to focus on the upside, but the upside does happen. You get more rent growth than you thought, and you get cap rate compression, and you sell for, and you make over 20% IRR. So it's both ways. And then looking down here, the annual rent growth versus your going in vacancy rate. This not as important, so I'll actually just skip over. But I do like, actually, we will look at that. So we're projecting 5% as the base case, right? We think market's going to stay strong and we'll be able to keep the place full. But especially for a Class B workforce housing, people always say, oh well, people that frankly live paycheck to paycheck and work service jobs and things like that, they always need a place to live, right? These deals are never going to lose occupancy. Well, if you look at the historical data, in recessions, occupancy does get hurt, and it gets hurt sometimes, depending on the market, worse in the more affordable housing rather than the luxury. People make the argument, oh well, the luxury is really where the risk is because those rents are going to get hit first and those people are going to want to scale down, and that's all true. But in affordable housing, market rate, you're going to see people double up. They're going to get roommates. They're going to jam a bunch of people into a bedroom. So overall, occupancies do go down. And we're projecting a base case of 5. If it goes out to 7, and we keep our rent growth stable, it's a 14%. So you can just see, I don't want to bore you to death with all the different numbers, but this is just kind of a range of outcomes. And the moral of the story is, can you live with these outcomes? So we could look at a different deal, and we could maybe see one that has a table like this, and the downside is not 10 anymore, it's negative, right? And those are the deals that maybe they're not necessarily the ones to stay away from, because maybe for your investment goals, you want to take more risk, you want to make more money. We love those kinds of deals. We do both kinds. But maybe that doesn't fit your investment criteria. Maybe you want a deal that after you stress it and you really beat it up, does it still return a positive return? And I think that really gives you the comfort to make investments right now at a time where it is so difficult to do so, just because valuations are so high. Do you want to put your money in the stock market where the stock market's at an all-time high? Do you want to invest in bonds that we have, I think, $15 trillion of negative yielding credit or bonds in the world. So a lot of people are happy with a negative return. And if you factor in inflation, our treasury rates are negative. So where can we get yield? Real estate, and you guys all know this because you're here tonight, real estate's one of the last few places that you can actually achieve yield in this market right now. So, and it's not because real estate's magic, it's because real estate is an operating business. Real estate is sticks and bricks and people, and so it requires effort. So I think that's pretty much it. Does anybody want to?
Can you cover the refundability? I can't even pronounce it.
Sure. So this is focused for bridge loans. So this is a great. I love to argue why bridge loans are great because I've been putting deals together for the last few years where a lot of people, especially with the rising interest rate environment of 2018, they said bridge loans, you're crazy. Interest rates are rising and we're gonna have a recession. Are you nuts? And we had to stand there and say, well, it's actually the optimal debt structure for our business plan, and we think it's worth the risk. So for a lot of you, this might be just too far, but he asked and we'll tell. So refinance risk is the biggest risk for a bridge loan. Like we mentioned earlier, if your loan is due in 2 years, you better have certainty that you'll be able to refinance that risk or refinance that loan or sell it or sell the property and pay that loan off.
With the changes in the laws here in New York, recently, all these valuations, your assumptions if you bought a property a year ago are totally off from what they just changed it based on rent increases of 7.
Right.
How does that
Yeah,
affect?
people are losing their minds. So prices are going down and nobody wants to buy. And I have we don't buy in New York. So we are more cash flow driven and focused on primarily Houston. And we've had a handful of groups that are New York focused and they're coming to us and saying, this New York thing's just not working for us right now. We want to hear a little bit more about what you're doing out of state because things are a bit more sane over there. So to answer, I don't know how to answer your question. I don't know how to invest in New York. The contrarian in me says, hey, prices are dropping. Maybe now's a good time to invest. I don't know. I'm not an expert, but it is a very challenging environment with these changing assumptions. So really quickly, refinanceability. How sure are we that we actually able to get out of our bridge loan? And what that means is, when you take on a bridge loan, you're usually taking on higher leverage, and more leverage than would be extended to you in a permanent loan. So what that means is you need to increase the value of your property to the point that you'd be able to take out your existing bridge loan with a permanent loan. So that means you need to, depending on the leverage, you need to increase the value of your property. That's pretty much as simple as it is. So the way that this calculator works is you plug in, when is your debt due? And bridge loans are usually due in 18, 24 months. So you put in right here, refi in 24 months. And then I've got my shocks, right? Because we love stressing things. So at operational shock, revenues go down by 10%. And when revenues go down by 10%, your expenses don't go down, right? So your income after expenses actually goes down by 19%. That's a big hit to your income. Capital markets shock, that just means investors, lenders, what's going on in the market. And I'm saying interest rates increase by 25% and cap rates, which are valuations, increase by 15%. So, people would be very stressed and not be in such great shape if all of a sudden they thought they were selling for a 7 cap, like we showed, 7 cap, and now they're selling for a 7 3/4. That's a big jump. So these are my stresses here, and those would play out on this table where, if here's your base case, right, optimistic, what's actually plugged into the calculator. Now the operational shock, as you can see, income went down quite a bit, 20% as we said. So that actually hurts the valuation to the point now your property is only worth $12 million. So this deal, we're not counting on a bridge loan, we're not looking to refi anytime soon. So that doesn't matter. Who cares if our property's worth $12 million if we're cash flowing 11%? Let's just keep on cash flowing. Eventually it'll be worth $15 million. But if you're relying on a bridge loan and getting out of it, you better have that valuation there, or a lender's not going to be able to extend you credit, and your bridge loan will be hung. Your existing loan will be hung, and you'll be forced to sell the asset at the worst time to sell. You don't want to sell when valuations are low. You want to sell when valuations are high. So this is really quickly operational shock, capital markets shock, and then what happens if both, right? Your revenue goes down and capital markets.
So Rob, say anyone here, they're single family, this question would be zero, but if you're small multifamily, large multifamily, and you're looking at a projection of 10 years, right? And we're preparing for a recession. How do you determine like your range for vacancy over that 10-year hold? If there is like say, oh, recession in 5 years, like how do you adjust your numbers?
Good question. So yeah, a lot of people are looking for the magic answer and say, all right, well, 10 years is the way to go then, because we might have a recession in 1 to 3 years. How do you project that in? And you can project it however you want. You could go year by year and say, all right, well, 2020 it's going to be 6% vacancy. 2021 it's going to be 7. You could do that. But to answer your question, I really think you should just get comfortable with an overall assumption, whether that be 5%, 6%, 7%, supported by the market and your data. But the idea isn't so much to factor in a recession into your model, but just plug in something that makes sense today, and when stressed, hold up. So does that answer your question? It's basically the idea of we don't want to be overly pessimistic, because like I said, we'll never buy anything, but we want to see, does it hold up to stresses? And so for a bridge loan, the number one stress is that refinanceability. And offline I can show an example of a bridge loan deal where you are taking that bridge loan risk. You better get that valuation done and get your business plan done and get that higher income in 24 months. And the key is you better have a big difference between what your permanent loan looks like once you're done with your business plan to what your existing loan is. Because if you take on lower leverage, like let's say 5 million when you could have taken 10, well, refining that loan is going to be no problem. You'll just take the $10 million loan, and if it's not 10 and the market's not doing well, it's 8. 8's a lot more than 5. You can take out that $5 million loan. So for me, it's a fail on this test when you have a new loan lower than your old loan, because that doesn't make sense. Your lender is not going to be happy when you try to pay off his loan with a new loan that's lower. So if we say, oh shoot, we need to pay off this loan in 18 months, there we have some failure. 7.3 is lower than the going-in loan amount of 7.8. So this deal would not work with a bridge loan. And that's the risk, is buying deals with a bridge loan because you want to get the leverage. You want to maximize your return, because more leverage, more return. But does it stand up to the shocks? So you want to see a deal that actually warrants a bridge loan, enough upside that it makes sense. So that's your question.
Do you have like a criteria on what your risk would be on using a bridge loan versus just?
Yeah. So when we're buying a bridge loan, we need a higher return. So if we're comfortable, depending on the market, the asset, the story, if we're comfortable with a 15% IRR using permanent financing, we need an 18% if we're using a bridge loan. That's just the requirement. That's not because we're greedy for higher returns. I mean, we are, but that higher return, if it's baked into the model, is going to basically build in more cushion, more room for error. Because if you are now projecting 18 and things go wrong and you don't hit it, you got a 15, you got a 13, you've got a 12. So it's just another mechanism, it's a risk control mechanism demanding a higher return when you pursue a bridge loan.
Average, what's the longest bridge loan you guys do? 3 years?
So the longest bridge loan I've seen is 5 years. At that point, it's maybe not necessarily a bridge loan, but and there's lots in between. There's lots of ways to do it, but the typical bridge loan is 24 months, and that's actually the longest we've done.
So you're saying that you wouldn't be able to refinance and get your value up in time for the refinance. How do you actually estimate how long it's going to take you to get it up to the value you want?
Yeah, good question. So that requires getting with our regional manager and boots on the ground and our general contractors and figuring out, well, the exterior work that your general contractor is going to do is typically able to be done right away, right? You're not there's no reason to wait. The waiting game is with turnover and getting into units that are occupied and renovating them and getting your rent increase. So you can do a calculation and it's basically this. If your turnover rate is, to make numbers really simple, 50%, that means you have a 100-unit property and every year 50 residents come and go, right? Well, 2 years you'll touch every unit, right, if my math's right. Because 50 years you'll likely see a turnover of every unit, and you'll be able to renovate each one, achieve a rent bump for each unit, and now you've finished your business plan. So, to your point, that input that we used early on, assuming that this is going to take 15 months for 144 units, and if you look at that math, that's actually pretty aggressive, right? You may not get there. So it's something like that of a calculation. Turnover, how many units do you need to renovate? Maybe it's already half renovated, you don't need to hit them all. So that is how we more or less determine the time it takes to stabilize.
Could you speak a little bit about buying a value-add asset versus something that's already stabilized and how that might impact your performance and valuations?
Yeah. Yeah, a stabilized deal or a core deal, as people call them, it's usually in a great area. There are no need for any renovations, and there's really not much upside. So a stabilized deal like that, your highest return is really achieved as the day you buy it, that going in yield, right? So maybe it's a 6 cap. And then it's the waiting game of unexpected expenses coming up, right? Or the market getting worse. Because there's nothing you are doing actively in your business plan to raise the income of the property and valuation. So those deals are actually more susceptible in a vacuum on an unlevered basis, are more susceptible to a recession than the riskier value add. So to quickly run you through the risk spectrum of a real estate deal, for example, we have got core, lowest risk, lowest return, right? You're not doing any business plan, you're not trying to raise rents, lowest risk, lowest return. Then core plus, you get an idea, it's just plus. Then value add, then you could say maybe deep value add, and then there's stress, distress, and then you've got development, building something that doesn't exist, right? That's the highest risk, pretty much. So along that risk spectrum, people think traditionally a core deal is the least risky. It's down here. But if you're buying that, and lenders usually like core deals and stabilized deals, they say, hey, you're not taking any risk, we'll give you more leverage. Well, guess what? More leverage and no opportunity really to increase your income. What's going to happen in a recession, right? If you had your income projected to be here, you have no way of increasing it. It's going to go down a little bit, and you've got very high leverage, so you have a lower margin of error. So you were leading me into this question here of what's the difference between stabilized and value add. That's really it. The opportunity of a value add deal is to buy good in-place cash flow. It's like cheating. And that's why there's so many people trying to do it, and so you have to be very careful and hunt and pick and find the right ones. But buying that in-place deal that really could support the leverage as if it were a core deal, and you could do nothing to it, but we've got that upside. So that's the answer there.
So what's your exit strategy? Let's assume it works out. Let's assume you buy it, you renovate, you upgrade the rents. So now you moved your deal from value add to stabilized. Who's your next buyer?
People who buy core assets, people who buy stabilized assets. There's billions of dollars out there. You've got insurance companies, you've got private equity. There's a lot of money, but it is a great question because a lot of people think there's an aggressive exit out there. And so people like us, we're not these big institutions and we're looking for value, we're looking for value add. And so what that means is on an income valuation basis, using a cap rate, we'll actually pay a lower cap rate for a more risky deal. That doesn't make any sense. But why is it? It's because the value add deal with a lower income in place gives you the opportunity to raise the income, whereas a stabilized deal, it's just got the income here and it's not going to move. So it's an interesting point because people think, if I'm buying at a 5 cap and it's a value add deal and I'm conservative, I should be able to sell it for a 6 cap. And that's, people typically say 1% increase to your cap rate, and that makes a lot of sense. However, The reason why you pay a 5 cap for that deal is because it had that upside. So when you're selling it, it no longer has that upside. So instead of projecting to sell at a 6 cap to be conservative, you've got to do 6.5, 7. So that's where there's confusion. People say, well, I'm a conservative investor. I underwrite to 100 basis points or 1% expansion of my exit cap rate, and life is good. Well, maybe takes a bit more thinking than just, it's maybe just not that simple. So to answer your question, we're cognizant of the different buyer pool of when we bought it to when we're selling it. But I do think there's a lot of liquidity there for yield hunting investors. Oh, let me take this one.
How are you, when you find these deals, how are you financing it? Do you have financing in-house that you're ready to put down payment with or on, or do you have to finance every single deal and go through that process for every single deal? And how long does that normally take?
Yeah, great questions actually. So we have lender relationships for most of the loan products that we're seeking. So if you're looking for permanent financing, it's usually access through delegated underwriting servicer lenders, which you've heard the big names, Greystone, Arbor, Hunt, CBRE. So there's the permanent debt there, and there's other loan products out there as well. And then in the bridge loan space, that's a little more, there's a lot of bridge loan lenders out there, but it is more of a space that requires a bit more navigation, and it's just, there's wider pricing. You can kind of get, to be frank with you, burned with bridge lenders. So with permanent debt, there isn't much delta between what you're going to get. It's pretty much everyone's pitching this. Everyone's selling the same thing. They're all selling you a Fannie Mae or Freddie Mac loan. So it's really not that much work. We still shop it around, and we do this internally. We essentially run our own capital markets, investment banking internally, and we make a market and reach out to our lender contacts. And this takes, usually a month to really vet out term sheets and our lender relationships, and then from term sheet to closing, that could be another 45 to 60 days.
When you're looking at a performer from a broker, what is one expense when you're underwriting that you typically see that maybe people mess up all the time, or from performer to actual projection? What is one that you see that not necessarily the broker's lying, but like, all right, that may not
They lie.
Sorry, brokers out
Yeah, sorry brokers, but they've got to sell. So let's take a quick look at their pro forma. So I've never seen a broker project anything vacancy higher than 5%. Right? So, and sometimes it's true, right? Sometimes it's just a really well occupied area and it's actually higher. It's going to be 98%. But it's pretty much what I've never seen. And guess what? This broker thinks that concessions are 0. So you're never going to have to offer any incentive for a tenant to come in. So that's probably not true. What else do we have? Loss to lease? No, all your tenants are going to pay exactly what you asked them. 0%. So those are a couple of them, but really it's all of them. And they're not the only evil ones. I'm evil too. Sometimes I try to make my deals look better than they are. And there's all the different ways to push on the deal and make it more aggressive.
And like another one that I've noticed, apparently it varies in different markets, but taxes. It's one, because like you said, on acquisition, Texas, or Harrison County, Houston, they recess this way. What is your advice to investors so they can kind of get that information themselves?
Property tax consultant.
Oh, just through the county.
No, well, there's big names out there, and they, specifically in Texas, we use Cantrell McCulloch, and they know more about taxes than we do, and so it helps. But let's see what they've got. So I don't even believe this. I don't think. Hang on. So they've got. Okay, so.
They listed 127. You already having 149.
Yeah. So somehow, maybe my analyst made a mistake, but somehow their pro forma taxes are lower than what's in place. I don't think that's going to happen. But just as a contrast, like we looked at earlier, we're projecting 192,000, and you know, to be honest with you, we haven't consulted our consultants yet. So the way we came up with that is purchase price times 70%. So it depends on the age of the asset, the location, the assessor's office, but you know, so there's really no great rule of thumb, but it's anywhere from 90% all the way down to 45% of purchase price, which ends up being your assessed value. So unfortunately, there is no perfect math there, but that's a great point. I mean, that it's so easy to get away with it and just say, well, taxes are taxes. And then I've never seen this before. 2.5% management fee. I'd love for my management company to charge me that.
1,000 units.
But
What do you usually pay?
3%.
3.
Yeah. So, you know, maybe we'll get there eventually. I don't know, but
Compress like the cap rates.
what's that?
They'll compress like the cap.
Yeah, exactly. They have to keep compressing. So, you know, all these assumptions, maybe they look fairly benign at face value individually, but when you factor it all in and you end up to their pro forma 882,000 NOI, you know, I don't want to look stupid, but let's just go look at what I'm projecting. Maybe I'm more aggressive than the broker. I hope not. But my pro forma year one says 708,000. So I basically think the sky is falling compared to the broker. This is this is an amazing deal. You should buy it. So yeah, it's a great point. You know, if you're getting into this, you know, brokers mean well, absolutely, and they know what they're talking about. Pick their brain, ask them questions, but this is what they have to do. They're operating in the best interest of their client, which is not you, it's the seller.
So can you describe your process from when you get a call, here's the deal, to possible closing? What are the stages of the deal that you have to go through?
Yeah, so the question was, when a deal first comes across our desk, what do we do? So number one, we make sure we have all the information necessary to fully analyze the deal. And by fully analyze, I just mean preliminarily look at the numbers, and that's the T12, the rent roll. And an OM like this is very handy. We don't need it. We have other ways to get our information, but this is a great start, even though it's a lot. And then from there, if the numbers preliminarily shake out to being something not terrible, most of the deals I underwrite, I quickly plug in all the numbers, and it's a single-digit return or negative. So I just push it off to the side and never think about it again. But if it underwrites to, you know, low teens, then it's worth thinking about more. Maybe we submit an offer 10% below the asking price, right? If they're asking 11 million, maybe we'll offer 10, so, you know, something like that. And we do that, we try to be in the habit of that regularly. So a good cadence for submitting offers, depending on how many deals you're looking to do, is maybe, you know, submit one offer a week, one every 2 weeks. You know, just keep putting those offers out there, because you never know, you might get that call back and say, that offer you submitted 3 months ago, now the seller's looking to talk. So that's the next step. Kind of vet the deal out more. Does it make sense for us? Let's submit an LOI. And if there is traction back from the seller that says, hey, your LOI isn't insulting, then it's time to actually get serious. Oh my gosh, what did we do wrong? If the seller's actually considering our offer, did we miss a number, right? So then we have to go through it, re-underwrite the deal, and then start looking at rent comps, market reports, and, you know, just as an example, I'm sorry I'm taking way too long on this one question, but and everything else. But here's a CoStar. I hate CoStar, by the way. Sorry. Sales. So that's the next step. Definitely analyzing the market and getting to know it, and having our regional manager check it out. And then from there, usually they say, well, the seller's not going to consider your offer until a principal of the firm has seen the property in person, and that means, you know, me or my business partner, which I have to get on a plane and check it out in person. You know, I come from a construction family, or, you know, real estate family. I know nothing about construction, so what good am I walking the property, looking at the foundation, looking at the roofs? You know, why do they need me there? But you've got to do it, so go see the property, and then we negotiate it further, and then we put it under contract.
But your offer is conditional anyway. That's something.
You want to sneak that in? Let's try to sneak it in. You can shut me down, but let's sneak it in.
What type of due diligence do you do on the expenses and the whole, the T12 to make sure it's accurate?
It depends on what stage of the game we're in. And so there's just too many deals, so we can't go deep early on. So we just pretty much accept the T12 or the historical expenses at face value, as unfortunate as that is. The due diligence that we do is on insurance. That's a big one, especially in Houston, and property taxes, that's a big one in Texas. And then we operate property, so we know the general, and if I don't know, my management company knows, right? They'll tell me, well, your average payroll is $1,250 per unit, your average repairs, maintenance, contract services, turnover is maybe $700 a unit, and you've got all these benchmarks that you can, so if you see a T12, like these guys, they might have made a mistake, or maybe they had a year where they overstaffed the property, but on the T12, they had $216,000 for payroll, and it's like, we were actually buying a property not too far from here, same unit size, and we know that we can operate at 175. So we have the confidence to underwrite that. So I'll leave it at that. I think that's it. Thank you very much.